Hello, everyone, and welcome to Risk Awareness Week 2021. My name is Jorge Salazar. I'm a risk practitioner based in Canada. I specialize in risk modeling using techniques such as time series analysis, Monte-Carlo simulation, etc. And in today's webinar, we're going to try to apply some of those techniques to assess price risk. We're going to try to model price risk, and we're going to discuss predictive modeling techniques. We're going to first introduce some predictive models that are being used in what is called predictive analytics, and that's integrated with machine learning. And we're going to compare time series modeling using Monte-Carlo simulation versus the predictions made by machine learning and predictive analytics. We are going to do a demo session in Excel where we select a predictive model and we apply that model to forecast prices, and then we add that price to a financial model. There is a decision to be made whether or not to go ahead with the project. Also, there is a decision whether or not to hedge that input cost, and we will continue the discussion of machine learning versus Monte-Carlo simulation in predictive models. And we are gonna also talk about libraries available in Python and the steps to deploy a predictive model. The basic models for price risk analysis or for price forecasting, the most basic one is the regression model, the linear regression model. There is a variable, in this case, the price, which is the dependent variable, and there are other variables that are the predictors or independent variables. The method used there is ordinary least square, but there are other methodologies to assess, to establish the regression equation. For instance, an airline company may have a linear regression model to determine the price they are going to charge for their tickets, and that will be a function of inventory of airplanes, demand forecasts, costs, operating costs, etc. Other models that are popular in machine learning are the classification models. We are trying to predict what is called a binary variable or categorical variable, is to place individuals in different categories. This is a discrete variable modeling. And examples of these are where we are trying to assess the probability. The probit model and logit model are for that. The probability, because it goes from 0 to 1. So it's 0 or 1 or anything in between. And 1 will be 100% probability, 0 is 0 chance. So that could be also true or false. In this example that I have there is a life insurance company is using this model to price their life insurance product. And to price that product and also to define the coverage, they need to assess the riskiness of the applicant. And there are tremendous amounts of data that the insurance companies could access to, data of people who had heart attacks and their age, gender, body weight, height, and that gets included in the model, and it will give you, if a new customer comes to apply for a loan, they will get a riskiness or a probability of having a heart attack in the next 5 years based on their own data when they fill out the forms. Then the model that I would like to focus more in this session is a time series model, where we forecast a variable, the the dependent variable is explained by its own past, and we can forecast the trajectory or the path for this variable into the future. Examples of models are the ARMA model, autoregressive moving average, or the geometric Brownian motion. We're going to discuss those in a second. But an application for this is, let's suppose we are a manufacturing company and we have input costs that are highly volatile, such as electricity costs or natural gas prices in the case of a nitrogen producer. So the idea is, can we forecast that input cost so that we can plan whether or not to hedge that cost, and also for planning purposes. So the question could be, what's the price of electricity for the next 12 months? Well, those are examples of models used to do pricing analysis. Now, there is this information revolution. There is a lot of data and also computer power. And we didn't have that in the past. Before, the analysts had to establish the model, and they will fit the data to the model. Let's suppose I select an ARMA model, and I will fit the data to my model. And then if there is, and I will use that model to make predictions. Now, with data analytics, what we can do is we can use the historical data and the predictive algorithms that determines the model. So we don't need to make any judgment. The computer is doing that for us. And that's where I think we can leverage machine learning and traditional analysis by using that computer power to determine what's the best model. Instead of me selecting what is the best model to forecast prices, we can train the computer to select the right model. We split the data into a training set and a testing set, and we show the different results we get with different models in the training area, and then we do that in the testing area, and we will select the model that has the highest accuracy. That's something that I'm doing, but it would be ideal if the computer can do it for me. And then as new data comes, the model gets modified. The parameters of the equation, if I selected a geometric Brownian motion, when there is more data coming, the parameters for that stochastic process get updated. Or perhaps in the presence of new data, the algorithm decides that there should be a different model, and that produces the predictions. Now, still is a guess. The predictions from predictive analytics, they are still uncertain. And the beauty of machine learning is that it builds its own models, but it doesn't tell us much about the probabilities of those forecasts. And that's the discussion that I have in this slide, which is we are not interested in the single point forecast. I know that a decision maker will ask you for a number. Give me that number that I need to know. As risk analysts, we need to make sure that uncertainty is captured in our deliverables. And as Nassim Taleb explained, it's not the forecast that is relevant, but the degree of confidence around that forecast. And traditional Monte-Carlo simulation, it gives you a probability distribution. For each point in time, the price you get is a probability distribution. It's not a single point estimate. So that's the advantage of Monte-Carlo simulation. Now, the problem with traditional Monte Carlo simulation is that it doesn't tell you which one is the best model. You have to select the model, and I'll show you in a second how to do that and what we expect the machine to do. No matter the technique, there's still going to be risk, either if it is Monte Carlo or machine learning. But my thesis here is that machine learning can improve Monte Carlo by helping with the testing of the model and to refine the model, so that we can use the best Monte Carlo model available. But right now, machine learning is being used a lot for basic predictions based on new data. Just to give you an example, I was doing a reservation looking for a flight from Calgary to Vegas for a few weeks from now, and it's giving me a price of $200. This is Google. So I Googled that, and Google is making a decision. It's giving me a recommendation based on a time series, the price for the last 60 days. And we can see that the price was 40, 50 days ago. It was more than double what it is now. So the price went down. Now, Google is assuming in its recommendation that the price may go up again to this orange yellow area, which we can define that as the interquartile range from 255 to 345. So 255 will be, let's say, the 25th percentile, the P25, and the 345, let's assume, is the 75th percentile, so the P75. The area, this area reflects the 50% confidence interval. And what Google is telling us is, look, if there is some sort of mean reverting process, then the price will soon go into this range. Now is lower than it should be. It's going to get into this range based on the past historical data. So this is an example of machine learning using panel data, because we have multiple dimensions of data. There is a historical data, a time series data, but we have data coming from different airlines. So in this case, we have Flair Airline, Air Canada, WestJet. So it's pulling from different companies the information, and is producing a series, is assessing the best flight at each time, and is making a decision. Now, it's not giving me the range. It's not telling me what's going to be in the future. It's just using the past, and it's telling me, I assume that the price is going to go up by now. There are other companies that have algorithms that are based on the classification models that I explained earlier, such as I think Hopper has a price engine that is, they claim 95% accuracy. I think Kayak they were doing the same. But just to illustrate how machine learning is being used and how it could improve decision making. In the case of a time series application in Excel that I wanted to share with you, let me show you a time series that I have for natural gas. And again, we are talking about a manufacturing company that has natural gas as its main input or raw material. and is the key driver of costs. And what we have is the last 20 years of data, monthly time series, and we can see that there was a lot of volatility at the beginning of the time series in the early 2000s. And then since 2009, since the, let's say, the financial crisis, the prices are way more stable. After talking to a subject matter expert, as a risk modeler, that's what we do. Is we talk to the experts on this, and they told me that in the last 10 years, you can't compare the last 10 years with the early 2000s, because there has been a revolution in shale gas. Investments made were significant in North America, and this is the price, the North American price. The Henry Hub is the NYMEX price, the benchmark in North America. I know for those in Europe or Asia, natural gas prices now are much higher, but in North America they still remain fairly low, and that could be because there is a lot of capacity that was invested in the past, and that's why we shouldn't be using, according to this expert, we shouldn't be using this period. So as you can see, this is what we are trying to train the machine, is to detect the regime changes in the time series. I call it regime change because there is a change in the parameters. The variance for this, the standard deviation, it comes down a lot. Another regime change is inflation rates. If you see those in the 90s, they were much higher than in the late 2000s. When you have a change in the mean value or in the average, that could be a structural shift in the time series, either a change in volatility or a change in the mean value. So we're going to select this period, and then we need to feed the data. And to feed the data, we select the data and we go to fit, and we select univariate time series, and we have several models to choose from. I just selected the entire time series, but I should be selecting only for the last 10 years. We can select the autoregressive model or the geometric Brownian motion model or the ARMA model, and then run this model and try to see how accurate it is. And this is where I think machine learning can help, and some people are doing this already, which is you train the machine to test in the testing data set to test these models and determine the one that is the most accurate. Instead of me doing that could be done by the machine. There are several time series models. For instance, we were just talking about the geometric Brownian motion, and this one is basically a random walk process with a drift. Mu is the drift, and we have volatility. If I increase that drift, that mu, from 2 to 8, we should see now the trend. The drift is more clear. The geometric Brownian motion is typically used for financial assets, assets that are in nominal terms. Is the theoretical stochastic process behind the Black-Scholes formula for valuing stock options. And we also have the geometric Brownian motion that reverts to the mean. So this model doesn't have a trend. it has only volatility. This is the model that is typically used to price commodities such as crude oil or natural gas, where there is, if there is excess supply, the prices are going to go down. If there is excess demand, the prices are going to go up. And that seems to be what's happening with natural gas in some parts of the world, where there hasn't been much investment in exploration and production, and therefore, after COVID and the economy is starting to accelerate, but the supply wasn't there to meet the demand. We saw that also with other commodities. So that could be what's happening. But according to the mean reverting process, what's happening now should push for more investment in natural gas. So we would expect in the future supply to meet demand and prices go back to normal. Other models are, we mentioned the ARMA, which is a combination of an autoregressive model, the AR, which is an AR process is basically the price of today depends on yesterday's price from the previous period. We have our autoregressive model of first order, but also autoregressive model of second order, where we say today's price or the price for this month depends on the price of the previous month and also the earlier month. And we were talking about the ARMA is made of the autoregressive and also the moving average. The moving average piece is is totally different from what you think in terms of a moving average calculation. If you generate the 50-day moving average for the S&P 500 index or the 200 moving day, this has nothing to do. The moving average stochastic process is basically a linear combination of stochastic errors. So it's saying that the price is a function of a linear combination of random shocks, and that's what's behind the ARMA model. That you will hear a lot of data scientists talking about the ARMA model and the ARIMA and SARIMA model. Those are being used by the data scientists, and but it's basically exactly this. It's a combination of two stochastic processes. ARIMA, the I stands for integrated because it deals with stationarity, which is I don't want to get too far into the details. But if the time series had a regime change, either it changes in the mean value or the volatility, the series is not stationary. The integration is something to deal with that. That's the ARIMA and the SARIMA. I'm talking for those who are already in doing predictive analytics and they have those available. SARIMA is the same concept but has a seasonality piece, and that's the S. So we select the model and we insert into the where we want to forecast. So in my model, I want to forecast for the next 5 years. So I'm selecting. My data starts. My forecast starts in September, and I do for the next 60 months all the way to 2026. I produce a forecast. And I also show the P50, which is the median, is the 50th percentile. That will be my single point estimate. But I also provide the confidence interval, which is the P5 and the P95, the 5th percentile and the 95th percentile. And with this, I'm helping making that decision of whether or not to hedge. The person in charge of hedge is saying, what's the probability of the price next month exceeding $5? If that probability is greater than 10%, we're going to hedge. So right there, we can see how we can influence decision making, not by giving a single point forecast. I'm not telling them that what the price is going to be. I'm telling them what's the probability of the price exceeding being below $5 and whether they should hedge or not. And that's what Taleb is talking about, is tell me the uncertainty you have. That P5 and P95, that's my 90% confidence interval. So for each month, the geometric Brownian motion is giving me a probability distribution. So we can see for September, the price can go between $3 and $4.9. That's the 90% confidence interval. So can you see how from a time series model, for each data point, at each point in time, I have a probability distribution. I have a log normal distribution as a result of doing the time series analysis. At each moment in time, there is a probability distribution. So that's the deliverable from traditional Monte-Carlo. Is not a single point, but a probability distribution with a range, so that the decision maker can make that decision of whether or not to hedge. Then this price risk data can be incorporated in a financial model for decision making. If we have a net present value model where for the next this one goes from 2021 to 2030, and it has revenues as well as costs, and we have uncertainty in this model, and the uncertainty is driven by the time series model that we just came up with. So for each year, natural gas price is a stochastic process. It's a random variable, and that random variable is, if you see, is the average for 12 months. So for 2023, it is taking the average of the 12 months, and is producing that as an input in my model. The other inputs in the model are the selling price, which is the price of nitrogen. That's a different model to forecast that. And also we have inflation rates and market volumes. What I'm trying to show is, if we add uncertainty in the model, then in the inputs in the model, then we also have uncertainty in the output of the model. In this case, the output will be the net present value. It's not producing that. We just see. This is the trend analysis, the trend chart for the natural gas prices, and the red line, that's the P50. That will be my single point estimate. That's the most likely. However, what we just said before is, we don't care about that single point estimate. It's going to be wrong. It's guaranteed to be wrong. What matters is the range around that. The light blue is the 50% confidence interval that goes from the P25, which is the 25th percentile, to the 75th percentile, P75. And I'm also presenting the 90% confidence interval that goes from P5 to the P95. And that's the range that we are presenting instead of giving and the confidence we have in our forecast. Again, this is the result of collaboration with an expert. Now, machine learning can get rid of me and the expert altogether and select the right model, which could be a different model, could be not the mean reverting model, and we'll also select a different period in the data, not the last 10 years, but it may go perhaps using a shorter time frame or a longer one. That's the beauty of this. Let me see again if I can get that output for the net present value, which is the deliverable. Okay, now model risk is not responding. That's and I'm using the free version of model risk that is available in the website. I'm gonna pass the link. It's in the slide deck. What we can see after we added uncertainty into the project, we added a price risk. Now we have also uncertainty of the net present value. The net present value, we're saying, goes from 391 in the P5 to 894 in the P95. So we can say we are highly confident that the project will have a positive net present value, but we're also communicating that what are the key risks of this model, as well as the volatility, and this is important for planning purposes as well. So we just talked about how to model a time series using a model risk is what I'm using right now. And the other thing that we needed to discuss is, okay, the selection of the models. I just wanted to show you what a time series analyst has to do, and how we can leverage machine learning to take over that. We went through a bunch of models. Also, we had to deal with the data, what type of, how long the sample period should go. And then what we did is we show how to use that price risk in decision making in an organization. I just mentioned that I downloaded Model Risk. There is a free version with 15 days of full functionality. You just have to go to the, if you Google that, it will take you there. Same thing with At Risk is the other application that is used for risk modeling. Another one that is free is the SIP Math Modeler. And the template, just for you, if someone wants to replicate my example, you can retrieve the net present value model from VOS software, which is a model risk in the examples, and the natural gas time series, which was the NYMEX Henry Hub, the North American benchmark. It's also available online. Now, I just wanted to continue on the discussion about machine learning and Monte Carlo, and how we can combine those to produce something that is better. Python is the coding language, but I'm not coding at all. What I'm doing is I'm leveraging from libraries that have all this code available. For time series, you have all these models that we were just talking about, ARIMA, SARIMA, all those are available, and you can create your machine learning project with those. So that's why Python is so popular. There are a lot of libraries available, but some people use other languages like R, or I heard another one called Julia. All the things, they keep coming. Same thing with forecasting models. Facebook came up with something called Prophet, and it's just overwhelming to keep up with everything that is happening. I feel that Python is a solid base to get into predictive analytics, and in this particular case of price risk analysis, it works well. So why you're telling me, but why you want to keep doing this? I just did it using at-risk and model risk in Excel. I just shared that with you. The point is that we can't deploy my model risk into production because the users have to have the same Excel add-in that I have, model risk or at risk. So we can turn my Monte-Carlo model, my predictive Monte-Carlo model, into a production system by using Python, and we can make it available to other people. And the beauty, again, with machine learning is what we were just saying before, which is the algorithm will update the data, and it will improve the parameters of the model. If I'm using the geometric Brownian motion, it will rerun it, and it will update that with more data, so it will become more accurate. And I don't have. And basically, I'm working myself out of the job, because now this is doing my job. Just a brief recap of what machine learning is basically doing is taking the data and it's splitting the data into a training set and a testing set. Is applying learning algorithms to the training data set, and that is producing a predictive model. So it will produce an ARIMA model and a ARMA model, or different model specifications, and then it will, in the test area, it will establish the accuracy of the model using the test data set. And that's what I'm doing to test my models. But with Python, you can get the machine to do it. So it will evaluate the performance of each alternative model, and it will select the model that gives the best or the most accurate results in the testing area. And that could be one algorithm, or it could be a combination of algorithms. So it could be a combination of models, and that's also super interesting, because perhaps the best model it may be a combination of the geometric Brownian motion with an ARIMA model, and once that algorithm, what model is determined, it gets deployed into production. But now, once we are in production, we get more data, and the more data we get, we repeat the process automatically. It will split the data into training and testing. It will recalculate the model again using the new data, and it will calibrate the model, either the same parameter, the same model with the same with different parameters, or it may do it may decide to change the model altogether, and it's repeating itself. So that's how I could see this the future of simulation, leveraging from machine learning and predictive techniques. Well, that's all for today. I hope you enjoy the rest of the webinars, and thanks for your time. And I look forward to hearing from you. If you have questions, I could be reach out. I'm in LinkedIn. And again, thanks to the organizers of the Risk Awareness Week, and all the best.